Hey, it's Tom here and welcome back to the channel. Now, if you're anything like me, when you look into a stock as a potential investment opportunity, you have a very basic checklist, at least at a high level, in terms of the things that you want to understand and have kind of a line before you make that investment. For me, that comes basically directly from Phil Town, who was a big influence on some of my early kind of learnings with value investing. And I've definitely evolved and moved on from some of the things that Phil Town teaches, but his core kind of 4M checklist is something that I still use to this day. So meaning, do I understand the business? Moat, does it have a competitive advantage? Management, is it well managed, obviously, and margin of safety. Does the price make sense? Does it offer me an adequate return with some downside protection and margin of safety as well? And a lot of those aspects of analysing a business can be reasonably straightforward. Oftentimes they're quite quantitative, but one of the most challenging bits, oftentimes for people, myself included, is really that management part of the equation. Sure, we can look at some quantitative data around management and their sort of skill and execution in the business. Have they generated a high return on invested capital and a high return on equity? Do they use, egregious amounts of debt that would make us uncomfortable? What's their attitude been to share issuance and share repurchases? Have those been done at intelligent prices? Are they paid egregious amounts in compensation, or do they have incentives that align with us as common stockholders? But there certainly can be quite a bit of kind of qualitative assessment in that exercise. And one of the books that you may have heard me mention in a couple of quite recent videos is this one, The Outsiders by William Thorndike. And I've just finished this book yesterday. And this book really has clarified a lot of things for me around management in terms of what do we ideally want to see in a public company CEO. Now, I'm not going to go through this whole book or anything. If you do want to check it out, I definitely recommend it. Just very quickly, this is basically a case study of 8 different public company CEOs. You could argue that there's a lot of survivorship bias in that. They've kind of just picked out the 8 that have the best performance or whatever. You can make a similar criticism of books like 100 Baggers by Chris Mayer, but there is an unbelievable amount, frankly, of overlap in terms of strategy that each of these CEOs implemented in order to be successful in terms of managing their operations with quite a often decentralized management structure, and in terms of how they thought about capital allocation. So I definitely recommend checking out those case studies, and I want to basically work through a few of the summary parts of this book. So at the end of The Outsiders, we get basically a checklist of what to look for in a great manager, a great CEO. There's also a really nice table in the book called A Shared Worldview, which basically shows various aspects of public company management, whether it be share repurchases or dividend policy or acquisitions or how often they spoke to investors. And you get a nice table of what the common trends are with great CEOs. And there is also a table in there, and I actually want to use one of my own investments as a case study just to kind of show you how this would look in practice. There is a table there called the Buffett Test. One of the things Buffett has said is basically a great manager, if they retain $1 of earnings, they should be able to turn that into at least $1 of market value for shareholders over a long period of time. So there is a table that shows how each of the CEOs in this book have performed on that Buffett test. And like I say, I'll use one of my own companies that I'm invested in that's not in this book as an example of putting them through that Buffett test as well, and how you might find the information to kind of go through and do that in practice. And if you do enjoy this video and get some value from it, be sure to hit like and also subscribe to the channel, particularly if you are new here. Taking a couple of seconds just to hit the like button on the video really helps me out a lot, helps the video get pushed out to a wider audience and all that good stuff. But without further ado, let's get straight into the video. And just so you can get a feel for the track record of these outsider CEOs that are written about in this book, again, these types of studies often have some level of survivorship bias in them, but nonetheless, this is what the numbers look like. You'll see that $1 would have grown over 25 years to over $600 in an index of these outsider CEOs, which was massive outperformance over the S&P 500. And this table here shows what these outsider CEOs tended to do around significant aspects of the business, and it really highlights their strong focus, I would say, also on capital allocation. So pretty much all of them, or in fact every single one of them, was a first-time CEO. Pretty much all of them retained a lot, if not all, of their earnings for reinvestment to grow the business. There were some that paid small amounts of dividends, but for the most part it was retained for growth. A lot of the investors in the book also bought back a huge amount of stock. Interestingly, Warren Buffett is actually the only one that didn't buy significant amounts of stock back at the time this book was written, which was around 2012. If we were to get an updated view of this table, I think that box would now be ticked for Warren Buffett. I don't think he's bought back 30% of the stock yet, but he's getting very aggressive in his share buybacks, that is for sure. These CEOs also tended to do very large acquisitions, so every single one of them did at least one acquisition that represented 25% or more of their market cap. Every single one had a decentralized organizational structure, so they let the managers of subsidiaries basically lead their own lives. Not a single one of them gave guidance to Wall Street. They all had one idiosyncratic metric, which is, a metric that kind of varies from the typical CEO. That varied a little bit dependent on what the business was. For Warren Buffett, it's float. For a lot of the investment managers, it's basically free cash flow and what kind of cash returns they can get out of their investment. And they also had a very high focus on tax, and that was actually one of the reasons that they often weren't paying dividends and they preferred share buybacks, just because they're not particularly tax efficient. But that tax focus emerged in some other areas as well, particularly around the way that they tended to structure their acquisitions or their asset sales. John Malone, for example, had this mountain of net operating losses that he could always kind of pull from, I guess, when he made a big asset sale in order to minimize the tax implications of making that sale. For Henry Singleton at Teledyne, it was using things like spin-offs. So there's some variation there, but there is incredible consistency around how each of these CEOs acted across these various aspects of their business. And William Thorndike, like I say in the summary of this book, actually lays out the Outsiders checklist, a checklist that he thinks that a lot of these CEOs would be going through, even if they're not necessarily actually spending time working literally through this checklist. These are the types of things that they tend to think about. So number one on the checklist is that the allocation process should be led by the CEO. So we see a shining example of this at Berkshire Hathaway, where the operations of the business have absolutely nothing to do with Warren Buffett. Pretty much. He has CEOs that manage each of the subsidiaries, but all of the capital allocation is very, very focused centrally at Berkshire and largely through Warren Buffett. So the allocation process should be CEO-led, not delegated. They start the capital allocation process by determining a hurdle rate. Again, at Berkshire, it's kind of been rumored for a long time that the hurdle rate is 10%. In other words, Buffett won't put any dollars to work unless he thinks he can get at least that return. Number three, they calculate the returns for all internal and external investment alternatives and rank them by return and risk. In other words, if they can invest internally in the business and get a higher, more certain return than they can by making an acquisition, then it would be dumb to do an acquisition. Although a lot of public company CEOs like to do that just for the sake of growth, but that is not the focus on in the kind of outsider CEO mind, at least. Number four, they calculate the return for stock repurchases, and they require that acquisition returns meaningfully exceed this benchmark. So again, take the Berkshire example. They've been doing a lot of share buybacks recently because it's the best investment opportunity available to them at the time. If they could buy a great company at a reasonable price and get a higher and more certain return than they could by buying back Berkshire stock, they would turn off the buybacks and make that acquisition. But more recently, that hasn't been the case. Number five, they focus on after-tax returns and run all transactions by tax counsel. That one's fairly self-explanatory, hopefully. Number six, determine acceptable conservative cash and debt levels and run the company to stay within them. So again, let's just keep using Warren Buffett and Berkshire as an example because it's the business that I probably know most well out of all the businesses mentioned in this book. Buffett has basically said that he will never go below, I believe it's $20 billion in cash in the insurance operations, so that if there's a hurricane or a tsunami or a cyclone or something and they are required to pay out a large amount of money to do with an insurance claim, they will be more than able to kind of meet that big payment. That 20 billion, I've heard people like Chris Bloomstrand argue that number is close to 40 billion now, but you get the point. They want to have sort of a financial fortress and not be at risk of relying on the kindness of strangers, as Buffett might put it. Number 7, consider a decentralized organizational model. Again, Berkshire's pretty famous for that. They have basically no one at headquarters relative to their wider employee base. Number 8, retain capital in the business only if you have confidence you can generate returns over time that are above your hurdle rate. So we'll get to that in a sec with the Buffett test of creating more than $1 in market value for every dollar that you retain. And that kind of leads us into number 9 here. If you do not have potential high return investment projects, consider paying a dividend. Be aware, however, that dividend decisions can be hard to reverse and that dividends can be tax inefficient. So that kind of gets at, if you start paying a dividend, there becomes sort of an expectation that you just continue to do that all the time, and that dividend will be very consistent and might even grow over time. Perhaps you're better off paying a big special dividend or something like that, maybe Costco kind of style like they did a couple of years ago. And finally, number 10, when prices are extremely high, it's okay to consider selling businesses or stock. It's also okay to close underperforming business units if they are no longer capable of generating acceptable returns. Now, again, if we use Berkshire as an example, they've been pretty open in saying that with very, very few exceptions, they will basically not actually sell any wholly owned subsidiaries at Berkshire. They will certainly sell stocks if they don't kind of like the future prospects for that public company. But they certainly have a couple of very famous examples of no longer deploying new capital into kind of poor performing businesses, and in some cases actually extracting as much capital out of those businesses as they can. The original Berkshire Hathaway textile mills are a very good example of that, where Buffett did keep them running for a long period of time just to kind of keep a few people employed, but over time he was extracting quite a lot of the capital out of the textile mills and obviously started redeploying that into other businesses, namely insurance companies. Okay, so the last thing that I want to cover that I got from this book, The Outside, is that it's going to be a nice kind of benchmark test for management teams that have been in place for a long time at businesses that I look at, is kind of the Buffett test. So for every dollar of earnings that a CEO retains within their company, are they redeploying that in a way where it creates at least $1 of market value? What you really don't want to see is a management team that retains all the earnings, they don't pay them out as dividends or anything, and then they go out and make dumb acquisitions that kind of destroy value for shareholders. What you want is, they retain $1 and maybe they turn that into $2. That would be really nice. And obviously the higher that sort of Buffett test ratio, the better, the more value they can create for every dollar retained. The better off shareholders obviously are going to be. So this is what the results look like for all of the CEOs in this book. You'll see that Buffett himself has a kind of Buffett test ratio of 2.3 times. So every dollar retained in Berkshire Hathaway at the time this book came out created $2.30 of market value. General Cinema was the best performing one at 3.6 times, and the Washington Post was the lowest performing one at 1.9 times. But even 1.9 times still significantly exceeds the kind of the Buffett test of at least a ratio of 1. Now, I thought a really interesting exercise would actually be to go into one of the companies in my portfolio and run the Buffett test. The company that really came to mind with this one was Thor Industries. Do your own due diligence on that particular company. I'm not trying to get you to buy it or sell it or anything, but Thor Industries has had a management team that's been in place for a very long period of time. They also operate a very decentralized management structure. They let each of the, in this case, RV kind of subsidiaries have their own managers, lead their own lives. They basically send the excess cash to headquarters, and that capital is then reallocated by the management team. And it was a very interesting exercise to kind of dive in and see how much has been retained in earnings at Thor and how much market value that has created over time. The founder is still on the board at Thor, has a massive shareholding. It's a 9-figure shareholding, over $100 million. So he's gotten very wealthy, but has he created, a lot of value for other shareholders? That's kind of the test we want to look at here. So if I go to the latest 10Q, which will have the latest balance sheet from Thor Industries, there is a section on that balance sheet that will say retained earnings, and as of the last update for Thor, that was $3.2 billion. Now, the stock price or the market value for Thor Industries has been pretty volatile over the last couple of years, really, but particularly in the last several months, the stock's actually down quite a bit. But even then, the current market cap is 4.43 billion as I record this video. So that would give us a Buffett Test ratio of a little under 1.4 times. So for every dollar retained, Thor have been able to create $1.40 in market value, or slightly less than $1.40 in market value. If we go back to May last year, when Thor Industries was at a much higher stock price, that ratio actually changed quite a bit, which was interesting to see. So if we use the market value back in May last year, that ratio would have been 2.6 times. So for every dollar retained, the Thor management had created $2.60 in market value. So after that big decline, the 1.38 or 1.4 times Buffett ratio is not as spectacular as many of the CEOs in the book The Outsiders, but we still are definitely north of 1. So that means that we haven't got terrible management making poor acquisitions and destroying shareholder value. So that's all I've got for this video. I hope you enjoyed it. Reading that book has really, like I said, clarified a lot of things for me recently in terms of how to think about CEOs and public companies managing their capital and making capital allocation decisions. And I learned a lot of nice little hacks like the Buffett ratio moving forward in my investing. So if you haven't read that book, definitely recommend checking it out. It is definitely getting a place permanently on my bookshelf. But that's all I've got for this one, and I will see you in the next video. Cheers.